So many of my own clients have been asking me about this relatively new concept known as home equity agreement. Now, some of you may have found this video because you received a mail or a postcard that suggests that you can get up to $500,000 cash on your home with no monthly payments, no interest costs, and you only need a credit score of a minimum of 500. And so some of you are thinking, wow, this sounds great. What's the catch? And what are some of the repercussions? Now, before I share my own thoughts and opinions about these home equity agreements as a financial expert, let's go and unpack what they are, how do they work, and what are some of the pros and cons of getting a home equity agreement. So right out the gate, a home equity agreement, also known as an HEA for short, isn't a type of a loan unlike a HELOC or a home equity loan. And I'll have a separate video comparing a HELOC versus a home equity agreement, HEA, in a separate video, so definitely subscribe and tune in for that. To put it simply, a home equity agreement is an arrangement whereby an investor or an investment company buys a small fraction of your home and actually becomes a owner with you. In most cases, when you enter into a home equity agreement, the investor or investment company will give you a lump sum cash, typically between 5 to 30% of your home's value. In exchange, the investor or the investment company gets a share in your future appreciation of your home. So unlike a loan, there is no monthly payment and there's no interest charge cost to you with this agreement. Instead, the company makes money by taking a share of your future appreciation of your home value when you decide to sell or refinance, and this typically happens within a 10 to 30 year window. But how does that exactly work, you might ask? So let's just say, as an example, your home value is $500,000 and the investment company, as part of the home equity agreement, decides that they're going to give you 10% of your home value, which is 50%. In exchange, they get 25% of the future appreciation of the home value. And over time, as your home value appreciates to, let's say, $700,000, which would be a $200,000 gain, the investor and the investment company giving you the home equity agreement will get the 25% of the $200,000, which is about $50,000. So that means when you decide that you want to sell or refinance, you would pay back the original $50,000 that you got from the investor, plus the $50,000 of gain that you got from the appreciation of your home value. In total, the investor or the investment company is going to be getting $100,000 from this home equity agreement. But also remember, you're coming out ahead by getting $150,000 of gain for yourself on top of the original $500,000 home value. But what about a scenario if your home value actually depreciates, meaning declines over time? After all, these companies only make money if your home appreciates. Now, in many cases, and after studying and researching many of these companies that offer a home equity agreement, it appears that they do also take on the risk of losing money if your home value drops. But this is also unlikely because typically real estate appreciates about 3 to 5% annually, according to Case and Shiller report, and that's especially true when we're looking at a 10 to 30 year horizon. And it's also likely that these investment companies and investors have done their due diligence and research as to which neighborhoods and which market and which metropolitan area would likely to see an appreciation in the next 10 to 20 years. So if you are in a market or a neighborhood or a city that isn't really growing and it's declining, then it's likely that these investment companies aren't going to be offering the home equity agreements to your city or to your market. So now that we got the facts out of the way and we have a basic understanding of how these home equity agreements work, let's go and talk about my thoughts on the pros and cons and some of the risks and dangers that you may face when it comes to getting a home equity agreement. Now, like any financial tool, it can either help you or hurt you depending on what you're doing with the tool. So first off, I can see how a home equity agreement could be useful and be applicable in certain situations. For example, maybe you do need cash for an emergency home repair or renovation to meet code requirements, whatever the case might be. You want access to cash, but maybe you don't qualify for a traditional home equity line of credit or a home equity loan. But with these home equity loans, they typically qualify with the credit score as low as 500. Maybe this might be an option for you to get access to cash so that you can make emergency repairs, renovations, or maybe simply pay off high interest debt. That could be a useful case scenario. Another example or scenario I can think of is maybe you decide or you have commitments of selling your home in the near future. So maybe you decide you want to sell your home within 3 to 5 years. You know for sure, in fact, that your current living situation is temporary and you have to move because of a job situation. Then yeah, I can see how a home equity agreement will allow you to come out on top and you have access to cash. It could be a useful tool for that type of scenario. Another possible scenario is that maybe just maybe, you see the possibility and the potential of taking that cash from a home equity agreement and investing into another opportunity with a higher yield, such as maybe a fix and flip project, a real estate project. But this is assuming that you have substantial expertise and high level mastery in certain investment strategies or topics. For example, I know a handful of individuals who are extremely educated, well-trained, experienced, where if they do a fix and flip project, they buy a house, flip it, they could earn potentially 20 to 30% return. But it took them years and trials and errors and mistakes of being educated, experienced to even get to that point. And even then, they're not guaranteed to make that type of return every single time. So while that is a possibility, just know that it does carry a degree of risk. Now, speaking of risks, let's go and talk about some of the dangers and risks that you may want to consider for different scenarios when using a home equity agreement. The first dangerous scenario that I can think of is that if your home appreciates drastically and significantly, let's say 10, 20, 30% increase in your home equity. Well, in this scenario, then it might have been better off that you got a home equity loan or a home equity line of credit as opposed to having an investor or investment company sharing in the appreciation of your home value. This is because your lender or the bank that's offering you a loan with a home equity loan or a home equity line of credit, they don't have any gain or profit from the upside appreciation of your home value. All they're making money out of is the interest cost and the monthly payments you're making. But with an investment company that's offering you a home equity agreement, their means for profit is just as high as how fast and how much your home value appreciates. Number two risk is, from my research, I've been reading that a lot of these companies, that if you decide you want to leave early or terminate your home equity agreement early, they may have some exit fees or early termination fees. So just know that you're going to be stuck with these guys for at least a decade or more, or at least until you sell. Another restriction or limitation that you might have with a home equity agreement is that, let's say you do want to get a home equity loan or a home equity line of credit, a HELOC, the home equity agreement may restrict you or limit you from being able to get one in the first place. And I know this might be hard to believe, but some home equity agreements may even restrict you from how much of renovation you could do, because through a home equity agreement, the investment company is basically a co-owner of your property. So they may have a say as to how much of a home renovation that you could do with the cash or the home equity agreement. And really the last risk, and probably the most important one out of all of these, is just sheer lack of understanding and financial literacy of the user getting the home equity agreement. Again, I'm not bashing on home equity agreements. I don't think they're evil. I don't think they're bad. I think they do have a time and place and useful scenarios, just like any other financial tool. But it's up to the user and how the tool is being used that could either be beneficial or could be harmful. My general philosophy when it comes to any decisions being made, whether it's investments, money, is to understand the risk. Anytime I'm looking at a real estate deal or a business that I want to buy, I focus and spend most of my energy on how I could lose money in this deal. And this is different from being a Debbie Downer or being in a analysis paralysis. This is a systematical approach of looking at a deal or a opportunity and asking, where can I lose my pants? And so if I'm applying that thinking with a home equity agreement, I'm going to do some research on the company. Who are they? Who are they backed by? Who are the founders? Who's in the research department being responsible for figuring out whether my home qualifies or not? And then thoroughly reading the agreement to understand, okay, where could I lose money? What's my risk? How does the company make money out of the situation? And really digging deep as to what is in the home equity agreement. And I'd be looking for discrepancies as far as what I'm being promised or told over the phone or an email, and looking at the agreement itself and seeing if there are any discrepancies or differences or anything that might be a gray line or really vague in terms of interpreting how the agreement could play out. My concern is that at the end of the day, a lot of people are going to look at this opportunity and see that they can get cash from their home and they don't have to make any monthly payments. There's no interest costs involved, and it could appear to be a win-win scenario between you and the investment company. But because of the sheer lack of financial literacy, I feel like a lot of people are going to be surprised at the end of the day when they decide to sell or refinance that they're going to owe quite a bit of slice towards the investment company. You see, as a real estate investor myself, I buy apartment buildings, houses, so I know how this business works. In most cases, these investment companies offering a home equity agreements also have their individual investors themselves. I mean, like, where else are they gonna get their money? So what these investment companies do is that they go out there and pull a bunch of investors together to raise billions of dollars of investment fund, promising those investors typically anywhere between 5 to 8% return. But the investment company also has to make money, right? So they typically charge a one-time fee or a management cost for raising those capital and bringing those investors. So these companies are typically profitable when they could expect, with research and data being backed, that they could see the market or the homes that they're investing in are going to appreciate anywhere between 8 to 10% or perhaps even more. And it's pretty common that these companies have a very high paying positions to do research, to do analysis, and figure out which cities, towns, zip codes are going to likely appreciate the most in the next 10 to 20, 30 years. I mean, these guys and gals are Wharton, Harvard, business school MBAs that work for these companies, and they do research and analysis. So really at the end of the day, they're banking on the fact that your home is likely going to appreciate in the next 10, 20, 30 years. So the way I see it is if you do end up taking a home equity agreement, it is essentially taking some short-term gains, but foregoing long-term gains that you could have in the next 10, 20, 30 years if you decide to stay in the same home. So if you're definitely thinking long-term, probably not the best deal. Again, I'm not saying all home equity agreements are terrible, they're evil. I'm not saying that at all. In fact, I definitely see the opportunities for it to be used for benefit and gain for you. So spending a lot of time understanding the risks, what could go wrong, and looking at it systemically, not from a, emotionally flailing your arms type of thing, but really understanding methodically what could go wrong and what are the benefits, I think in most cases will lead you to a better financial decision than not. So if you've been considering taking a home equity agreement, maybe this video helped you out make a better decision, maybe not. Maybe if you have a friend or family that's also in the same decision, share this video with them. I hope that this video was really helpful in helping you understand what could go wrong, what are the benefits, and just sharing my own thoughts and opinion as a financial expert with a decade of experience about how home equity agreements work and what I think about them. So with that, I'll have some more videos comparing home equity agreements versus HELOCs and how you might also use a home equity agreement to pay off your mortgage faster. So definitely stay tuned and subscribe, and we'll see you in the next video.